So these name badges are fairly easy for us to print off. So we use them for our practices. So we just can change out the template and print something else on it. So it makes it nice and easy. So maybe I should have told you that. I spend $15 on every single one of these things. So you guys can have a nice name badge. So no, I'm just kidding. So anyway, all right. So that's all my announcements that I have. I wanted to get some feedback from you guys. So I did mute all your microphones and stuff, but I do want you guys, if you have the ability to turn your video on, go ahead and do that. And I have a couple of questions for you. I want to get some feedback from the last event before we dive into the content today. So the content today is not going to be as heavy, especially for some of those of you that have already been in multifamily for a while, or even just real estate in general for a while. It won't be as complicated, but it's still something that's very, very important for a lot of people to understand, especially as they're getting started. But first thing I want to ask for everybody, and I want you to kind of, give me your feedback here. And I think the best thing to do is just, turn on your microphone and start talking, okay? Unless we can figure out a different way. I think this will probably be the best way to do it. But I want you to give me some feedback on the one-sheeter that we put together, because that was the first time that we put together the one-sheeter and first time we did that. So what was the feedback what is some feedback that you guys have about that one-sheeter? What could we do differently? What did you like about it? Various things like that.
Hey, Dan, this is Edward.
Hey, Edward.
I like the one-sheeter. One comment I would say is I didn't have a ton of time to prepare for the first one. And the people that showed up were more interested in really the basics, to be honest with you. So I sort of went off of the one-sheeter and sort of tailored it to the audience that was there. So that might be helpful for other people too. I said, here's the subject matter, and be glad to go through this as much as you want to, but they really started asking questions, and we sort of veered in a different direction because it was a relatively small group for the first one. So I sort of tailored it to them.
No, I think that's great. That's good. That's an important thing to understand too. Is the content that we're providing is definitely for a kind of a broader audience. So if you have a smaller closed-in group and you survey them when you first get started, and most of them are just getting started, or they don't really understand what you're talking about, then it's not a bad thing to kind of change it up a little bit and kind of meet them where they are. So that was a great idea, Edward. And I think other people that should listen to that and also do it as well. So great feedback there, Edward. I appreciate that.
It's Marina here. Mm-hmm. So same as Ed, I went a little bit off script because we also have a small group. Actually, most of the people there, I knew them. And so they were more interested as investors. So I answered a bunch of questions there based on my experience. But the one-sheeter definitely was helpful.
Good. Thank you, Marina. And then Charles also just, he doesn't have his microphone or camera on right now. So he did make a post on there on the chat box and said it was very helpful. And it was short and to the point and served as a good reminder while standing in front of the room. So thank you there, Charles. Anybody else?
Hey, Dan, Greg Butcher here in San Diego. I thought the one-sheeter worked real well. We only had 2 people show up besides the co-organizers, but that gave us something just to go off of, have a little informal discussion with folks. They were both newer people who were just learned about multifamily also, so it just gave something good to kind of discuss and put in light of our own experience also. So that went really well.
Good. And one thing, just so all of you know this, one of the things that we've actually done differently, and one of the things we're going to be doing moving forward, is we're in the process of actually doing some more promotions for everybody's local market. So for example, your market, Greg, we actually have starting to leverage other platforms, not just Meetup. So we're actually now on Eventbrite. I'm not sure if some of you saw that or not, but if you go to Eventbrite, your event is actually posted on Eventbrite, and it actually leads them back to the Meetup page. And then we're also going to be posting them, because we have a pro network account with Bigger Pockets. We're going to be posting them all on the Bigger Pockets page as well. So you should start to see these groups starting to build up as we start to do them, month after month, and it becomes consistent. And the most important thing, Greg, is to, make sure you tease up that next month so that that pros 2 people want to come in next month. So then 2 more people will come. You got 4 and then 8, and then, kind of builds up from there. But the biggest thing is being consistent with it. And that's one of the things I found the most with some of the most successful groups is that if you just stay consistent, the group will continue to grow because people will want to continue to come back more and more for that content. So thank you for that, Greg. Anybody else?
Hi, Dan.
Yes.
It's Lisa.
Hi, Lisa.
Hi. September is going to be my first meetup. So I was just wondering if the group had any advice or what I should expect or what kind of marketing I should do. Apparently I already have 299 members on the site that were there when I became the co-organizer, but just how to get the right kind of people there.
Sure. So one of the things that I would highly encourage you to do is if you haven't submitted your headshot, do that so we can go ahead and get you those social media graphics. And that's one way to do it is to post those social media, because you'll get social media graphics for not just Facebook. We usually send them to you for Facebook, Instagram, and LinkedIn. So you can actually be posting those on your channels and your platforms. And of course, if you're in some local groups, you go ahead and post them in some of those local groups to be able to get that extra exposure. And from outside of that, and outside of just talking with some people in your local market, we do most of the marketing on our end as far as promoting it on Meetup, Eventbrite, and Bigger Pockets. That should help to continue to build that back up. And of course, the consistency will help to build it as well. And so, but as far as the marketing,
at the meeting, like when the meeting starts, should I have like an assistant there to help sign people in? And what's the flow of your meetings?
Sure. So I should probably have Stacy send you one of the very first videos that we did, so you can kind of see. We went through a lot of like different things about the flow and the structure and things like that. I think would be really helpful for you. And I'll touch on a few things right now that will probably be a better video for you to go through, so you can see a lot more of the various nuances and things like that. But when people first come in, you'll have a sign up sheet that Stacy will send to you for them to fill out. That will capture their name, phone number, email, and then I think it says on there about whether they're new to multifamily or not. And that way you can kind of understand where they are. The people that are new to multifamily will get an email that will allow them to watch a webinar to kind of get them introduced to multifamily, so they understand a little more about all the different basics of multifamily, so that the next meetup they come to, they're a little more educated and they can understand the material that you're presenting to them. And then if you want to have somebody there as an assistant, you can, but I know some people run it and it's just them. So it'll just be them. And of course, as you grow, we'll hopefully have other co-organizers that can help you with it. And the goal is to have at least 2, but up to like 3 or 4 in each meetup area. And the reason why is because you might be out of town one month. And so if you had another co-organizer, you could still be consistent with your group and still meet up, because they could actually host that meetup.
Yeah, I have a couple of people in mind already that I'm reaching out to.
Okay, good. So that's one way to do it there. And obviously, when the structure of the meeting is also basically 20 minutes of networking in the beginning. You do 20 minutes, 30 minutes of content after that, and then it's on the one-sheeter, I think, isn't it, guys? I don't even know if I think actually that's actually on the one-sheeter. I'm gonna pull one up here.
Yes, it is.
Okay. And let me show you that one sheet.
And I would also like to share something with everyone. I brought my laptop so I don't have to have them sign in on paper that I will have to type later. Also, because I'm a realtor, I know that usually, during open houses, if you have them put on paper, it's illegible. You just have them type in.
That was a great idea. That was a great idea. Bring the laptop, have them just type it in. That was awesome. I like that, Marina. I have this one-sheeter up here I'm going to show you so you can see what it looks like. So this is the one that we did in August, Lisa. Let me share my screen here so you can see it. And I have a large screen, so let me take this down and then zoom in a little bit so you can see it. Can you guys see that okay? So this is the sheet that actually you'll get, and it'll actually lay out the schedule. So 15 minutes of networking, 15 minutes of introductions, meaning going around the room and having them, tell them a brief introduction, 1 to 2 minutes about who they are, where they are in multifamily. and then 15 minutes of you providing the content about what we're going to be talking about later today. I mean, later this session. And then the last bit is networking. And this is a rough like guideline. Like if you wanted to do 20 minutes of networking and 30 minutes of introductions, you could do that. But this is kind of the formula that we feel like works the most, is to try to keep it, because you don't want to spend 3 hours at this meetup either. You could really do that if you start to get 20, 30 people and they're all spending 5 minutes each doing an introduction. So and then what you'll find as you start to do more and more meetups is that when people are coming back each month, they're not going to do this long drawn out 3 or 4 minute introduction. They're going to go, yeah, I was here last month and I'm doing this and this, and looking forward to networking and connecting with everybody else here, that kind of thing. But if there's any announcements, then we'll have them on the one sheeter as well. So there's just making sure everybody signs in, talking about the summit that we have coming up. And we do a revenue share with all of our meetup group co-organizers with that. And then the how to get started in multifamily webinar for new attendees, that to just kind of tell them that they'll receive an email with that. And then the content that you're going to provide today, this was last month's content. And then of course the actual content, bulleted out here is there so that you have that in front of you when you're speaking. And at the bottom has the next month's topic. So you can go ahead and tease up the next month so they know what to expect next month. And that way they want to keep on coming back in every single month. So okay. This is pretty much the flow of it, and we try to give that to you each month as well, so that you always just have it there in front of you whenever you need it.
So for the first meeting, is it reasonable to expect 3 people or 10 people, or it just varies?
It just varies. I mean, I think some groups it can be 20 or 30. I mean, and it just depends. So what area is it again?
Detroit.
Detroit.
Area.
Yeah, Detroit, we already have 239 or so people that are already part of that group. So it's possible that you could have more. But I mean, I would expect for your first one, a handful maybe. And if you're really surprised, you might have, 10 to 15, but it really just depends on how many people. Do you know how many people are already registered?
I think 5 or 6, but I'm also a real estate broker and a flipper house, investor. So I have a lot of contacts that I've been telling. I was just waiting for this meeting before I actually broadcast it out to everyone.
Sure. Yeah. So, I think that especially with your own, presence and authority already in the market, you'll probably have more than that anyway, just because of your own networking and your own, marketing that you're doing to it. So, I mean, I think, it's just going to depend on your first event. So like Greg was talking about, he had 2 at his first one. We did one in Charlotte for the first time. And our first one, we had about 15. So it just depends on your market. And a lot of it has to do with how soon you set the actual location. So if you haven't chose a location or venue yet, the sooner you do that, the faster it starts to market out there and more people know where it is. They can kind of see how fast they can get there from getting off work or whatever. And then also when you set that location, make sure you send an email to Stacy, because when you set that location, then she will update it on Eventbrite, and Eventbrite will start to promote it, and then Bigger Pockets will promote it in a different way and stuff like that too.
Okay. It's set. I'll send her the email.
Okay, cool. Good questions there, Lisa. And I'll make sure Stacy, I believe, is on here. So I'll have Stacy email you that video link so that you can see that first video where we went through a lot more about the choosing a venue, where to kind of do it, various things like that. And I think that would be very, very helpful for you.
Thank you.
So, yep. All right. Anything else from anybody else? I'm going to go ahead and go into the content today and go through this. And some of this stuff will most likely be new for some of you, and some of it'll be repeat. And you'll be like, oh yeah, that makes sense. I've done that before. So anything before I get started into the content? Any other feedback or questions or comments?
Dan, quick question here. I know you're calling this Multifamily Mondays. How tight are we to always doing it on a Monday if we have our own scheduling conflicts, or the folk where we're getting feedback from people in the group that Mondays just aren't a good days for people?
I would send an email to Stacy and she can work that out for you. That's not a problem.
Okay.
Yep. We prefer it to be on Monday, but if there's, limitations in certain things, then we could be moved. So
thank you.
All right. So let's go ahead and dive into the material today. So today, we're going to be talking about, we're going to be talking about the content that you're going to be sharing and providing for your meetup that's coming up on September 9th. And and it's all about trying to, pick and kind of choose a multifamily market, right? And let's see, let me just make sure. Is that the right topic, guys?
Yes, it was.
How to actually choose your market. All right. So this is actually something that's going to be, something that we've actually been working on quite a bit lately, because we do a lot of market research before our group actually goes in and actually acquires a property. We actually just got awarded a deal in Raleigh, North Carolina. So I know Ed will be interested to know which asset that is. I'm sure he's probably already curious about it.
Right. Yes.
It's a large deal. So it's a $51.5 million deal. And we've been looking in the Raleigh market for over a year, and we are really excited to have been landing this one. And the seller on this one actually was a seller that we bid on a product in an asset in a different market around the same price range, and didn't get the deal because they awarded it to somebody else. But this seller has actually got like 20,000 units in their portfolio and has a really good reputation. And they actually told us that they got started by, the best call script for talking to prospective investors is actually this afternoon. So it's going to be at 4 p.m. Eastern. So this one is for the content for the meetup. I know I probably confused a few people with that, but doing 2 webinars on the same day. But we will get to that one as well, William or Bill, later this afternoon at 4 p.m. So anyway, back to my story here. So they actually got started doing syndication. So they started with multifamily syndication, and they said that, that was one of their biggest concerns on the first deal we bid on, is that, can you get the equity? And, since that deal, we've done, several other deals and raised some pretty significant capital. And this one, we're gonna have to bring about 16 million to the table. And I know we're gonna be able to do it. So we were able to convince them that, we can do it. So we're looking forward to this one. But Raleigh was a market that, was in our original stack of markets that we were choosing and we were looking at, because we wanted to see, what was it that, okay, I'll update the Meetup platform. Sorry. So we were looking at, what was it about Raleigh that attracted us there, right? So we're looking for, not just we, but in general, when you're looking for a market to choose, you want to make sure that you're looking for certain market drivers, right? And there's a couple of them that you will want to, point out when you're talking to your group. Number one is incoming population growth. So just population growth in general, right? You want to make sure that there are people moving to that area. So if you look at a state like Illinois, Illinois actually has negative population growth. And so, obviously certain cities within Illinois might be different, but, there are most of the population, there are a lot of incoming and high growth markets in the Southeast, which is why a lot of people are going there. So the Southeast and Texas, and oddly enough, in California. So there's actually quite a bit of population growth going on in California. I was looking at a census report recently, and it was showing a lot of migration into California, even though it's a very high cost state. There's just a lot of other things that attract people to those markets. But you talk about markets like Texas, Florida, even in the Carolinas. The U-Haul company, they recently put out a report, and they track U-Hauls going into and out of a state. And so I look at those kind of reports as well, and seeing, what is it about a state that is allowing me to, not a state, but an area that wants me to invest in it. And in that report, the top 3 states was Texas, Florida, and South Carolina, which to me, I wouldn't have thought South Carolina would have been that high on the list, but it was. But one of the things that you have to do to be able to do that is you have to use certain resources. And so one of the things that we use is the census website. And 2020 census is about to be launched next year. And so they're going to be doing that. And so we're going to get a lot more data in the next 2 years. We're going to get a lot more data from that census to be able to dive deeper on various, data points. So there's software that you can use like CoStar. You can use Axiomatrix. Yardi Matrix has a platform. RealPage has stuff. Those are software programs that you can use that basically takes all of that data from the census website, as well as other properties that they're in their database, and they actually aggregate that data into one software platform. Now, all those software platforms you have to pay for. So you can't just go to that place. You can't just go there and, and just use it for free. But so those are the paid platforms. So I'll just go through them real quickly again. We have your CoStar, which is probably, actually, I think RealPage is actually number one. I heard that recently, but CoStar is a very popular one that a lot of the brokers will use. You also have Axiomatrix, and you also have RealPage, and then the other one is Yardi Matrix. So even though CoStar is owned by Yardi, there's also, I think, a separate one that Yardi Matrix uses as well. And they might have merged those two. I'm not sure, but those are the four main ones that I know of. But there's also, and they can be pretty expensive. So until you get, several, 100 units under your belt or whatever, it will be more cost effective for you to do a little more, dive on yourself to where they're getting this data. One of those places is the census website. So when you go to the census website, there is information there. You can find rental trends. So you can see in a particular market, what are the vacancy rates? What's the average rent? What is the average number of average rent for the bedrooms, size bedrooms? The population you can do by all kinds of different drivers and things like that. There's also population estimates, and so you want to use all that data to see if that particular market is in a market you want to invest in. And there are on the census website markets that don't have a lot of data on them. And so it's a little bit more challenging to try to find information on them. And for me, if there's not enough market data on the census website for it, it's most likely not a market that I'm going to invest in. Because if the census website didn't find it appealing enough to actually put data out there on it, most likely it's going to be too small of a market that you're going to have. You could still go into those other smaller markets, but it is going to be a little bit higher risk for you. So you're going to have higher reward for that as long as everything goes well and you can actually sell it. But one of the things that we look for and try to find those hot markets that'll be, what we call blue chip stable markets. And what I mean by blue chip is there's companies that are large corporations that, provide stability to an area, and those are called blue chip companies. And you want to make sure you have a market full of those blue chip companies, and Raleigh is full of them. I mean, there's a lot of them in Raleigh that are just really causing a lot of growth in that particular market. And so I would highly encourage you to dive into that census website to kind of see a little bit more about where you can pull that information. Another resource, which I saw somebody mentioned on here, Jamie already, there is a website called city-data.com, which also aggregates a lot of this information, and it's all for free. So that they don't actually charge you for it. You can go there, type in your zip code, and it'll get down to the zip code. Even sometimes smaller than that to give you some data. It gives you crime statistics and average unemployment rates and things like that. And median household income growth is another driver that you want to make sure that you're looking at, because you want to see that there is a growing median household income growth year over year. And so if you look at a market and you see that it is stagnant, then chances are, if you're trying to project, increase in rent projections in a market that's now flattened out, it's gonna be very hard. I had one of our investors recently reach out to me, and she wanted me to review the underwriting of another property that she was looking at possibly investing in. And I won't mention the city or the property or anything like that, just for anonymity's sake, but it was a property that they were going to be holding on to for 10 years. So it was actually a longer hold than I like to do. I usually do a 5-year hold, typically sell within 3 to 5 years to maximize the returns for investors. And so it was a 10-year hold, and the value of the property only increased by $100,000 in 10 years. And so for me, I wouldn't want to invest in that property because there's not a lot of room for error, especially in some of the modeling that they did on their underwriting. And so, one of the things I would also, as another extra kind of side note, encourage you to talk about at your meetup is, don't chase after a high cap rate. And the reason why is because if you're in a market that has a high cap rate, chances are you're going to probably be exiting at a high cap rate. And so for me, I don't mind buying at a lower cap rate, because if I'm buying at a low cap rate, it's because I'm in a really good, solid market that's commanding that low cap rate. And chances are I'm going to sell at a low cap rate as well. And so if you kind of do the math and think about it that way, you think, all right, if I can, spend, the same amount of time, energy, and effort increasing the net operating income on a 5 cap market property, I'm increasing the value of that property by $2 million on exit, versus if I do that same amount of work, that same amount of increase of 100,000 in an 8 cap market, I've only increased the value of that property by 1.25 million. And so some people would argue and say, yes, but if you buy it at 5, you're probably going to sell it at 6. And I would argue and say, well, I'm still better than you at your 8, because I'm still at 1.725 million increase versus your 1.25. And if my 5 goes to a 6 cap, then your 8 cap is going to probably go to a 9, 10, or 11. So you're going to be, even less than $1 million in increase in valuation. And so one of the things you always have to do is yes, you have to buy right, but you also have to sell right. And I think the selling right is probably more important than the buying, because you could overpay for a property, but save it on the back end when you sell it, because there's so much meat on the bone in the middle that you can, increase rents based on your renovation plan and where the deltas are from your market rents and your pro formas, that you can really close the gap there and still have a really sweet spot and a sweet exit on the back end. And obviously on underwriting, you don't want to project that you're going to, enter and exit at the same cap rate. You want to make sure you have some expansion there. We typically do 10 basis for every 10 basis point spread on the entry and the exit for every year that we're into it. So if we're into it for 5 years, we're changing at least 50 bips on the entry and exit cap rate. All right. And so those are a couple of things. That's a couple of resources for you. And again, a lot of this about picking a market is really going to determine what kind of assets you're looking for. But I would even encourage you that even if you're looking for some of the smaller assets, under 100 units, 50 units, something like that, even smaller, even a duplex, I would still look for a market that is a good, solid market, because if you're quote unquote paying a premium for that property, guess what you're also going to be able to do? Command a higher rent. And so, obviously when you buy something that's a little bit higher, you're buying it higher because there's that potential for more revenue on the back end, or, throughout the hold of the property. So always be considering that into your marker. So, I'll just kind of digest it a little bit here, kind of break it down. So number one, obviously we're looking for population growth. Okay. We want to make sure that the actual area is growing. Number two, we want to see increase in median household income. So we want to make sure we're looking at that. Number three, we want to make sure that there are blue chip companies surrounding the property and surrounding the market to make sure we have a stability in the market. You look at the markets around the country that did really well during 2008 when it crashed. It's those cities that had blue chip companies that were surrounding them. They have those main operators. They had you had your IBMs and your Boeings and your large corporations that were surrounding it, right? And a lot of your technology companies that, they're not going anywhere, right? They're there for the long haul. And so those are three things. The fourth thing, can you think about what the fourth thing might be that you would want to make sure you had in a market? It's going to be jobs, right? You want to make sure that there is incoming jobs. And if you have those blue chip companies and you have incoming population, guess what you usually have? Those people are coming to that area because there are jobs that are being created. And so one of the things that I always do in a market is I always go to the Economic Development Committee's website. And usually on that Economic Committee's website, there will be a news section, and it'll tell you different news about, what's happening on that particular market. And, I'll pull one up here that I saw in the Raleigh market recently, because even though I choose a market, I'm constantly looking into that market and making sure it's the markets that we want to be in. And I saved this because I thought it was a great report that it's called the Wake County Economic Development Report. Let me share this with you so you can kind of see what it looks like. And this is just for your information, just to kind of help you. You wouldn't necessarily present this at your meetup, but this is a report that they put out on a regular basis. This one was just updated. You can see here, August 1st, 2019. And on this report, this is what I like to see. Look at this. In the last year, right, from October to July, there are 94 companies that are represented in this report. A total of 7,390 jobs in this report, 470 million in total investment. There's been 18 new companies, and 76 of those companies that are in the market already are currently expanding. And so these are the kind of things you want to see. You want to see that there's actually growth happening. Now, this particular market had a lot more than just 7,300 new jobs, but in this particular report, this is a self-reported document where these people in the market that are expanding and growing, they're reporting this to this economic development committee so they can keep track of it. But those are the kind of things you want to look at, because when you have an asset that you now are ready to syndicate, you want to have information like that at your fingertips that you can show and present to your investors to kind of, quote unquote, sell them on the market, right? You want them to understand the market as much as you do, and you want to get them excited for that market as well. Julio also said home values increasing. Yes, that's another market driver that you want to have as well. And that way you can, I was just reading Greg's about having the one pager before these preparatory webinars. That'd be a great idea. And I'd probably be a little bit more prepared myself too, Greg. I appreciate that. I'll make sure I'll work with Stacy to try to get those done ahead of time. So we can have those ready for you, and at least the bullet points of what we're going to be covering too, so you can kind of follow along with it. So what we did last time, what we're doing today is I'm usually going over the content, and then she, from my content, creates the one-sheeter based on my content. So that's good. All right, no problem, Greg. We're figuring this thing out. All right. 3 and 4 are a little bit redundant. Do you mean they represent current job and future job respectively? 3 and 4, I'm not sure what that means. What do you mean by that? You can go ahead and turn your microphone on, Marina, if you want to clarify that. 3 and 4 are a little bit redundant. Do you mean
where you said blue chip companies surrounding the area? So that means existing jobs? And then economic development, that means future jobs? Is that what you really mean?
Correct. Yes. You want to have incoming population growth. You want to have blue chip companies to make sure you have stability in the market with the existing jobs, but then you also want to have jobs coming into the market. So you want to have that growing job force as well. So, and then you also have to look at the incoming supply that's coming into the market too of new properties. I'm not too concerned about the incoming supply, because that's usually more for your A-class properties, which we don't acquire. We're acquiring only B-class properties, usually B to B plus. And actually this Raleigh deal that we just got under contract, it actually is a B plus property in an A area. So we're really excited about that, because when you start to see some sort of market correction or dip in the economy, those A-class people will want to stay in the area, but they don't want to pay the high premiums in the A-class property. So they'll come to our property, which is a really nice B property in that A area. And it's a very, very solid kind of, hedge against some of that downside. But good question there, Marina. Hopefully I answered that.
Yes, thank you.
Yep. All right. So any questions around the ways that you would want to pick a multifamily market? So obviously you want to make sure that you're in a market that you can sell in as well. And so I've had several investors reach out to me and they say, hey, I got this deal. I'm like, middle of nowhere. Yeah, I got a great cap rate on it. It's like, 12% and yada, yada, yada. And it sounds all great. But you start to look at that market, and number one, no one's ever heard of it before. So number two, it's going to be hard to sell that property because no one's ever heard of it. And usually those properties are the ones that you're going to find on LoopNet and CityFeet and stuff like that have been on there for, a year, because nobody really wants to buy and invest in that market. And so they have to sell it at a high cap rate for anybody to even try to get it. And so you have to kind of keep that in mind when you're thinking about it. So that you can understand whether or not you want to do it. Now, if you're just buying it for yourself and you just want to hold it for the rest of your life, then that's obviously a totally different story. But when you're trying to get a deal and get it under contract and bring other partners in and people that want to invest in that, it's going to be a lot harder to sell that to them than it is a property that's, say, in Austin, Texas, or Raleigh, or Charlotte, or Dallas, Texas, or all of these different markets that are really good, growing, high population, high income, high median household income growth, home values. I mean, all the drivers for a market are going high. And so you want to constantly be looking at that. And then the last thing I would say to kind of wrap it up is you want to be looking at multifamily market reports. CBRE puts one out. Marcus and Millichap puts one out. Cushman and Wakefield puts one out. CoStar puts one out. Yardi Matrix puts them out. You can just Google them for your area, for your city, and they'll usually have them. And if they don't, reach out to your local brokers, because they will send them to you. They will say, yes, I have a report for Raleigh, North Carolina, or you know, I don't know, New York City, you know, wherever you're at, they have a report for your particular market. And so you can look at the national ones, which I think are important. Those usually come out quarterly, but then you can also get those reports from your local brokers as well. All right, so I'm going to open it up for any questions that you might have. I know I kind of went through some of this really quickly, but it should be pretty straightforward content that you can provide. And I think the biggest thing that you can give to your attendees at your meetup is going to be resources. And so those resources are going to be those websites, those free websites where they can get a lot of this market data to see if it's going to be in a market that they want to invest in. So go to the census website, the census.gov, and like Jamie mentioned, probably the one that I use quite often and more than the census is that city-data.com, especially if I'm doing a quick analysis on a property. I want to make sure that I see that, that quick analysis before I even look at a property. I want to see that quick analysis on that market, and not just the market as a whole. It's like micro analysis, right? You want to get down to that sub-market inside of that market, because there's certain, as you guys know, there are certain sub-markets in every single city that you would not want to invest in, right? So even though the city as a whole MSA, the metropolitan statistical area, might be growing and expanding and have great, drivers, you might have that sub-market, that little pocket in that area that's not. And city data will give you that information down to that little sub-market. So make sure you look at that. The crime statistics as well are on the city data website as well, Julio. So you can do that there too. Marina says something about not mentioning, excuse me, let me scroll this down. We didn't mention anything about rent increase. So yeah, so when you're looking at a market as a whole, if all those market drivers are there in place, you're going to see that there are going to be some rent increases. But what I'm really concerned more about is the current rents on that property under market? And can I increase them organically to that market rate? And then, yes, I want to look at, future rent growth. And a lot of times that future rent growth is in a lot of those multifamily market reports. So you can see over the next 5 years, how much would I be able to organically, push the rents if I did nothing else? If all I did is close the delta from my current property's rents to the market rents, and then just had a rent growth based on those projections, well, how would the property perform? So I want to be able to see that as well. But obviously we're value add. I'm usually a value add. I know most of you guys are value add players, right? So we're looking for properties that have a value add component to them. Renovate the interiors, add some additional amenities, bring it up to a current standard and modern amenities and interiors, and then be able to push the rents and to that market's ability. And so, yes, we're still looking for those, but when I choose a market, as long as those other market drivers are in place, chances are, I've never seen a market that doesn't have increase in rent growth and increase in rents from that. So as long as those base ones are there, you should be able to see that as well. All right, which site do you use for crime statistics? The citydata.com. I use Neighborhood Scout, so that's a good one. Is that a website, just neighborhoodscout.com, Marina? Okay, yeah, it's just neighborhoodscout.com. That's great. Driving around is also a good idea. So obviously, that's a very good idea, because again, there's nothing like, you can't replace physical in-person interaction, right? So to actually go to that market and actually sit into that market and actually drive the properties and tour the properties, pretend you're going to be renting that place and kind of touring a lot of these different areas, you're going to have a hard time. That's something that we primarily do when it comes to finding an asset. When we find that asset, we're going to definitely go drive that area. We're going to drive that property. We're going to drive the comps around that property. We want to see exactly what that neighborhood looks like, because Google Maps can only show you so much. Trulia, Jamie said, also has a crime map. And let's see. I also think that if you work with a property, they will tell you, yes, the property management companies actually, if you can, start to find a couple of property management companies in the areas that you want. This is kind of after you choose, but they will give you a lot of those reports from CoStar and Axiomatrix and things like that. That will give you a lot of the data about what's the average rents in the area, what's the average vacancies, what's the average rents, and the per square foot rents and various things like that, and what have been the actual gross from year over year. So a lot of that information is in there as well. Wanda says drive after 7 p.m. Yes, that's correct as well. That's a good way to look at that market. And then she says statistic.com also has great information. So all great resources. And I don't have anything else. So if you guys have any questions about the content, and she said it's statista. So .com. So you can see that there in the chat box. So any questions from anybody about this particular topic or the event coming up on September 9th or anything like that? I know as you move forward, for those of you, it's your first time, you might have some questions as you're trying to put something together or things like that. And Stacy will definitely be a resource there for you. And I'm fine to be a resource too. I just know that Stacy is usually a little bit more responsive than I am sometimes with emails when I get a little bit behind and busy and stuff. So, but you guys can certainly reach out to me if you have questions. I want to be a resource to you as well. So, my email is just dan@multifamilyinvestornation.com. So that's just dan@multifamilyinvestornation.com. So,
I have one question. It's slightly off topic, but somebody mentioned home value increase. So I can understand if the home value is getting higher, people can't afford, so they will rent. So that's a good thing for rental properties.
That's great.
So I have seen some projects where the per unit price has gone up like really high. So my question is, while I understand, a small investor, if the apartment per unit price is too high, they would just go out and buy single condos, for example. But a 200 unit investor, they're not going to go out and buy 200 unit condos. How concerned are you if the per unit price for an apartment is slightly higher than the average, similar condos, for example?
Mm-hmm. So there are two different types of renters. There is a lifestyle renter, which means that they are electing, even though they have the financial ability to buy a house, they're electing to rent because they want to have that lifestyle. So for those people, that's where you're going to see in those markets, those rents going higher than what they could if they just rented or if they just actually went and bought a condo themselves. And a lot of times it's in those areas where they know that they might only be in that market for a couple of years and they might be leaving. And so you're going to see that in a lot of those types of, especially education areas, you're going to see that a lot of times as well. And then the other type of renter is a renter by necessity. And so when you have a renter by necessity, it means that they can't really afford to buy a home, right? So they have to rent. And so obviously if they can't buy a home, then they're forced to stay in that market. And so you have a mix of those, but usually if you're in a market where the per unit price is starting to be higher than the replacement cost or the cost for them to be able to, buy a property or a property for themselves, it's usually going to be in a market where you're going to have a lot of those lifestyle renters where they don't necessarily want to buy a house because they don't want all the extra liability of things breaking and things like that. And they want to have the flexibility of being able to move. That's usually going to be in an area that has a lot of millennial population in there as well. So I like those markets because there's, especially like Charlotte is a very high millennial population growth market. So is Greenville, South Carolina, Raleigh, North Carolina. Those are all and the reason why is because they're usually, obviously Charlotte's more of a financial district market. They also have a lot of fintech in there. There's a lot of IT. And then of course, Raleigh also has a lot of IT in it as well. And so you see a lot of that lifestyle stuff happening there as well. But I don't think a lot of people really, I'm not really too concerned with it as much as long as the statistics and the data match what the actual property is commanding. So if you're the only one bidding on that property, then, obviously you might want to take it into consideration a little bit more about, what you're going to buy. But if you're buying a condo, you might not necessarily have all of the nicer amenities and things like that some of these other properties have, depending on the property. Some condo properties do have some of those things. It just depends on where it's located.
So it's more like because you're buying value add. So let's say if you buy at a per unit price of 100,000, once you do your value add, it might gone up to 150 when you project 5 years down the road that what you're going to sell. And let's say if the area similar condos are at 120, are you worried that the next buyer might say, oh, the condo average is only 120, but this apartment is asking for 150, even though by using income approach, you would appraise it at at that value.
Mm-hmm. No, I wouldn't be too concerned with it. I mean, I haven't actually, honestly never really, when I've put a offer on a property, went and looked and said, well, let me go see what a condo would be, and kind of pricing it back and forth with a condo versus an apartment. Because usually people who are buying an apartment aren't looking to see what can I buy at a condo for. They're looking at, hey, that's usually some sort of either reason why they need to, so they couldn't even afford to buy the condo even if they wanted to. And so you're kind of comparing two different things. So even though there might be some correlation there, I don't think I've ever seen anybody actually look at condo values versus what you're paying per unit for an apartment.
Yeah. So as an investor, a large scale investor, that wouldn't be a problem.
It's not a consideration. Yep. All right. Well, I am glad everybody was able to join us on this today. We did record it. We'll be sending out the recording and getting the one-sheeter out to you as soon as we can. Thank you guys so much for joining us. Looking forward to having you on next month and hearing some of your feedback from the September 9th meetup. So thank you guys for joining us, and we will see you guys next month.
Thanks, Dan.
Thank you. Thank you.